Hello, everyone. Welcome to the weekly roundup. Today we will cover inflation, growth, and market sentiments. Hello, Ben.
Hey, Eva,
Bright and sunny.
bright and sunny day. Summer is here.
Yay. Allergy season.
Mm, yes, exactly,
We,
as
we'll get
well,
through that first and then enjoy summer.
for sure.
Okay, this has been an interesting week so far. We
Mhm,
saw Canada's headline CPI drop to 1.7%,
mhm.
while core inflation held steady at 3.2%. Now, with the Bank of Canada primarily watching core inflation, what does this mean for interest rate decisions next week and for Canadians generally?
Yeah, so that I think is probably the biggest mixed message that we've seen in some time. So, because a lot of the conversations I have is around that. They say, okay, well, inflation's down to 1.7, so that should be good news. That should mean that everything's coming down, and it should mean that rates continue to come down. But to your point around core, I mean, because core is really the number that the Bank of Canada looks at and most central banks look at, probably puts them on hold. So we went from something like a likelihood last week of close to 80% chance of a cut next week down to, I think we're at 27% as of yesterday. So it looks like they're on hold, and it'll be important to watch and see what happens. Some of that data is still from the start of the year, so will be interesting to watch and see what happens. We still anticipate rate cuts this year, but certainly not in the next meeting, and unless something materially changes this week.
Okay. There's been some talk in the news on renewed tariff tensions and the Canadian economy.
Hmm.
So my question is, are we really headed for an economic slowdown?
Yeah, I think that we're pointing that direction right now, anyways.
Mm.
So we're pointing for the economy to slow. I think one of the things, love it or hate it, the Bank of Canada did last year is they started to cut early and before most other central banks. And so that has helped to some extent. That's helped the consumer. We've seen mixed data come out from the banks with the Bank of Nova Scotia and National Bank today, both reported earnings. So most of the banks have increased their loan loss provisions, which typically is a signal that they're concerned about the outlook for the economy. And so a lot of their thinking and decision making will be driven around what the economists are thinking. So the answer to that question is yeah, I'd say we continue to head towards economic slowing. Some of it is tariff related. Businesses every day in both Canada and the US are closing down. So you see there's a big textiles business in the US that closed. And so, a lot of these are related to, we'll say, tariff or trade tension more than anything. So, where if you're in the United States and you support the direction of the government presently, then you'd say, well, look at all this revenue that we're generating. But it's a very, short-term boost to longer-term slowdown.
I think you picked into my sheets because I was going to ask about the bank's Q2 numbers. So is there anything else there worth noting?
Yeah, so I think that as I've learned over the years, as I look at when the banks come out with these numbers, and I think maybe coming out of 2008, I had scar tissue around the pain that you went through with the financials, particularly in Canada and the US, was that, setting aside loan loss provisions must be something that we panic about, and we need to be worried that things are going to get worse. But what happens is that the banks are trying to preemptively prepare for some of the potential defaults that may happen within their books. So while, it's more, I'd say, prudent that the banks do this, and certainly the Canadian banks have been quite prudent to set aside loan loss provisions in the event that they need to use them. But what happens if we get a reacceleration of the economy, which I expect we do, I'm not saying tomorrow, but I expect in the next, 6 to 12 months, we get a reacceleration in the economy. Then if they haven't used those loan losses, those end up being tailwinds for the banks. And so as they start to decrease that number, that ends up being a positive. So, The in national banks financials today, it was increased, we'll say financial markets, and that's really companies raising, refinancing debt, raising additional equities, some mergers and acquisitions. So there was some, I'd say, more positive activity in the last, we'll say, 4 to 6 weeks around that, and that was part of the positive numbers that came out today.
Okay. Let's go to the markets. Market sentiment has been sending a bit of mixed signals lately. Gold is strong, oil is wobbling. There's an unusual bond yield dynamics. Break this down for us. What should investors be paying attention to right now?
All of it.
Fun.
I, I mean, I think the point is there is a lot of cross currents, and I think that's right. I think that I'd say the one or the two major things that I continue to look at would be rates in the US dollar, so bond yields in the US dollar. And so the US dollar really is the thing that can have an impact on all of those assets. And so we've seen US dollar weakness. And in turn, you've seen higher yields. So what happens, at least in US government bonds, is typically as you start to get to these levels, the 30 years around 5% and the 10-year US is around 4.5. As you start to creep up to these higher levels, you tend to look at long-term buyers that tend to step into this market, and so that would be the institutions, the pensions. In a lot of cases, they control the likely path forward for many assets because when yields move up to these levels, the actuarials that say, here's how we get to our pension goals. At 5%, we're pretty happy, and so you start to see kind of that ebb and flow as we get to 5%. Maybe they take some equity off and buy some bonds. Historically, this is what's happened, and that's pushed the U.S. dollar up and bond yields down. So those would be important things to watch. As for oil, I mean, oil, I think really is going to flip-flop here as the economy is a little bit uncertain. And gold, at least, has been the kind of the risk on, risk off trade recently. So on a day like yesterday, where we saw risk on, gold was down. Today, when it came into the markets this morning, we got markets down, gold's up a bit. And so I'd say those would be important things. But US dollar and yields, I think, would be, I'd say, the most important things to pay attention to.
Okay. Let's go into the charts.
All right. I think there's another level of some. Can you see that now?
Yes. Yes, I can.
Okay. Okay. Perfect. Yeah. So I know the charts weren't up for everybody last week, but I think some of that has to do with some changes within teams. So the couple of steps to get through. So we're recording this a little bit early this week. Have something on the go tomorrow. So this is May 28th, 2025. Recording at about 12 o'clock. So anything that happens remainder of the week, we'll comment on again next week. But to the top of the question, Eva, when you asked, this is what the charts look like, and so it's this is since May of 2020, so a reasonable time frame just to look at what we're seeing here and why there is some concern here. So as you see, the red line here would be core, so this would be the core inflation number, where the blue line would be the total CPI. And so the reason we're starting at this point is this was basically the height of COVID. So we were in that period where we didn't have anything going on. And now we saw inflation run away. Core didn't get up that far as well. We did start to get up to these levels where they got concerned while financial conditions tightened, saw inflation start to come in and total CPI continued to come down. And now we see a slight reacceleration in core. So this has caused the bank to have some concerns. And part of this is to do with the tariffs and trade war going on. So it's important to see what happens from here. Does the next print come in higher or lower? what happens to total CPI. It's also an important metric to watch from an economic perspective. And so what did this result lead to? So basically leading to a sharp rise in Canadian bond yields. As bond yields go up, prices go down. And so if we look here on Canada, the 2-year went up 16 basis points, month to date 22. So, but from year to date, still lower, but just give you a sense on what that's meant. And then on the 10-year, 18 basis points, 25 months to date. So when you're starting at a 3% level and you go up 25 basis points, that's a significant change in percentage. The further out you go, the more volatility you get in the bond market. And so similar down, we look down in the US, as I mentioned, 30-year at 5 and the 10-year at 4.5. And these are pretty material basis point changes as well. So certainly very important to watch. And if you look at the other markets of the world continuing to rise, based on the fact that inflation's seen a slight reacceleration. So we've asked a little bit about what are people thinking, what are all the different categories thinking, and what's the momentum like. And so I think this is a reasonable way to look at it because there's various factors. This is quite a busy chart here, but you have cyclical conditions, you have monetary conditions, you have momentum, valuations, and sentiment. With the risk off on the red side and the risk on the green. So if you look at all these currents here, cyclical cycles, US economy, global economy, financial markets, so this would be jobs, manufacturing. So a lot of this data is, to your point, on the risk off, we'll say negative side. Markets tending to disagree with that, but that's what they're saying at this point. Monetary conditions, so these are a lot of the things that I talk about, of course, which would be rates, yield curve, etc. And so again, the cost of money is negative, which means money supply hasn't really kicked in materially. On the slight positive side here, you'd have relative momentum, absolute momentum. And so these two things would be slightly into the positive. So global equities versus bond momentum. So that means that stocks are moving up where bonds are moving down. And so global equity momentum as well, tilted to the positive side. Then on a valuations and sentiment scale, valuations continue to be stretched, particularly in the US, and so that'll be important to watch. And then sentiment as well, slightly negative, but when you look on the scale, we got down to maybe a 3, and now we're at like a 70, and so sentiment is certainly tilting back towards the neutral side there. And so I've talked quite a fair bit about diversification, looking at international markets, particularly end of last year. I said it made sense to look at diversifying away and looking for some opportunities there. This is a great snapshot of just the emerging countries. If we look on this column here, this is year-to-date basis. So MSCI emerging markets up about 10% year to date. If you look at the S&P, it's flat year to date. So just to give you a sense of the differential between the two. Some countries doing better than others. This one here, I think, would cause the U.S. president a lot of angst as the Mexican market is up 30% year to date when the U.S. market's flat. So interesting to watch and think about. Economic news headlines don't necessarily reflect what happens in the markets. And I think it's important to think about that when I'm looking at structuring portfolios. So I thought this is a great chart just to look at year-to-date performance. As always, the opinions expressed here do not necessarily reflect those of MBF. Should you have any questions, concerns, happy to discuss or speak with your advisor directly. As always, feel free at any time to reach out about any of the slides or anything we discussed in there today.
Thank you, Ben.
Welcome.
So what are we looking at for next week?
So we get into a new calendar month next week, of course, and so we'd be watching to see if we get a follow through. May was a little bit calmer month than we saw in April, of course. Lots of volatility in April. May calm down, so volatility's come down across the board, and we see if that continues. Of course, the Bank of Canada meeting next week we'll be watching closely. and continued corporate earnings, and see where that follows through from here. So onto next month, and see what happens to market levels at this point.
Great. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of the video. And we have just resumed sending out emails. So you would get a notification of our daily blog post. For our clients, please reach out to me if you have any questions or if you'd like to book a portfolio review meeting with Ben. Thank you for listening. Bye.
Thanks.